Hello, my name is Dennis Brooks. I'm a graduate student here at the Colott School of Business. I am in charge of online creation of tutoring content for AC 200 and 201, and this is going to be Chapter 24's video on capital budgeting and investment analysis. You can reach us at UAB here at Colott Tutor Lab at uab.edu. Or you can reach us at Colott Space Tutor Lab on Skype if you need to set up a session or you have a question that you want answered that isn't covered in any of the tutoring material. So we're going to talk about capital budgeting. Capital budgeting is the process of analyzing alternative long-term investments and deciding which ones to buy. These are usually particularly impactful or risky decisions to make. Reasons being, the outcomes are uncertain. Large amounts of money are usually involved. The investment requires a long-term commitment. The decision could prove difficult or even impossible to reverse if the outcomes are not favorable. Managers often use various types of measurables when they make these decisions. I'm going to go with 5 of them that are the most common and then tell you which one is the most common one. So, for instance, the following details are used to compute several different methods of analyzing capital expenditures. Here, the cost of the investment was $72,000. Annual net cash flow is, that's what your annual net cash flow after tax is, everything. That's net. $24,000. And in this case, we're talking about payback period. Your payback period would be 3 years because annual net cash flow goes into the cost of the investment 3 times. We're going to say that there was a salvage value of 0 on this item that we're buying, investing in, and it has a depreciable life of 6 years. So payback period is the cost of investment divided by the annual net cash flow. And as we talked about, we already know that's 3 years. Then we have the accounting rate of return called the return on average investment. It's computed by dividing the after-tax net income by the average amount invested in it. Annual average investment equals beginning book value plus ending book value divided by 2. On this one, we did that, and it came out to, because remember we said it has no salvage value, so 72,000 plus 0 divided by 2 gives you 36,000. And that would be your accounting rate of return on your investment. Net present value applies the time value of money to future cash inflows and cash outflows, so management can evaluate a project's future benefit and costs. The net present value decision rule. When an asset's expected cash flows are discounted at the required rate and yield a positive net present value, then the asset should be acquired, because that means you're going to make more money from it than if you just sat on your cash for that same period of time. Typically, when they do that, they're talking about, 6, 7, 8 years, whatever it is. The other measurement that they use is the internal rate of return. Internal rate of return equals the rate that yields a net present value of 0 or better for an investment. Hurdle rate, that is the minimum acceptable rate of return. The internal rate of return rule. If the internal rate of return minus the hurdle rate is 0 or greater, then you accept the project. So say here we've got a hurdle rate of 8% and our internal rate of return is 8.5%. So that means we have 0.5%. Going by the internal rate of return rule, we should take that investment. So that is what they use that for. Now, I'm going to go down here to this. Management surveys have shown that IRR is by far the analytical tool of choice by about a 4-to-1 margin. With MPV coming in second, then analytical accounting coming in third, and then all the others. There's about 5% for everything else. In your texts, this is just me as a tutor talking to you just as a student. In your text, there will be a section with tables concerning net present value, IRR, and other functions that you will need to reference to arrive at several of the computations needed here in your homework or elsewhere. However, with that said, do yourself a favor and get a financial calculator of some sort. You will absolutely need to know how to use the tables in your book for solving this chapter's problems and in future accounting classes. But in the long run, a good financial calculator will do all of this faster and better than the tables. I personally use the Texas Instruments BA2 financial calculator, plus you'll need the financial calculator in Finance 310. I was asked by the instructor who primarily teaches 201, or who used to primarily teach AC 201, what the biggest thing that he would recommend to his students that are finishing up AC 201 and getting ready to go in to Finance 310. And I told him without hesitation, because I took Finance 310 right after I took 201, and by far, financial calculator will do more for you. I did do a couple of the B problems out of your homework, because I wanted to make sure to point out a couple of things to you. So over here, these are even cash flows, even though you're going, wait, that's not an even cash flow. But it is an even cash flow because this is actually 24-1C, I believe. I'm not sure. But what it does is it's showing you what your cash flows are, net cash flow, value of 1 at 7%, and for how many years. And then it gives you this. It is very important to remember in your cash flows here that you include the machine that you're making that decision to buy or scrap or sell, but it's important to remember to include the salvage value of the replaced machines that you sell in your cash flow for the year you sell it. I could pretend I'm from Oklahoma University, but I've already told you I'm from UAB, so that doesn't really work as an excuse. I messed up. Part 2, this was the same problem, just another part to it. And in here you'll see where I'm telling them to highlight and make sure you include the salvage value of the new freezer, and then the salvage, this is where they're making the decision, sell the old freezer and buy a new one. And in this one, the question was sell the old freezer, buy a new freezer, or repair. And in this one, they went with repair the new freezer instead. The question was repair the new freezer or buy a new freezer. And so instead, they repaired the new freezer here. But in this last year, when it reached its final year, it had a $20,000 salvage value. So you have to remember right there, remember that you have to include your salvage values in your calculations. Here you have your revenues year 1 through 8, 68,000. Operating cost year 1 through 8, 30,000. Year 8, you got $8,000 from selling the new machine that you bought back here in year 1, and salvage value of the old freezer that you sold back here in year 1. And this is the one that you sold in year 8. You acquired it year 1. You sold it in year 8. Here, you sold it in year 1. And that's where these numbers are coming from. And it says, remember to use the sale value of the old machine now and the value of the new machine when you sell them for your NPV calculations. This concludes Chapter 24, which also concludes AC 200 and AC 201. My name is Dennis Brooks. I'm a graduate student here at UAB. I have done the vast majority of these for you guys, so hopefully they have been helpful. And again, good luck with your studies and going forward into accounting. You can reach us here at the Colot Tutor Lab at colottutorlab@uab.edu, or you can reach us on Skype at Colot space Tutor Lab, one word, at UAB. No, there's no at UAB on Skype. It's just Colot space Tutor Lab. Anyways, thank you. Hope you enjoyed the videos.